Hi, this is Kirk with Forex Strategy Secrets. In this video, we're wanting to talk to you about time frames. 4-hour time frame, which is a larger time frame, versus the 30-minute time frame, which is a smaller time frame. You can see here, marked in the red line, that's representing where you've seen a great entry signal on a 4-hour chart. Now, you may have gone and timed it on a smaller time frame. This is where the 4-hour first said to start looking. Now let's go look at the 30-minute. The 30-minute is representing the green lines. On the green line right here, this is the point where you really got a good entry signal on a 30-minute. So this little trend right here would have been great to trade. And so if you would have taken that on the 30-minute and got out here where it had some good exit signals on different time frames, it would have been 76 pips. That's what you would have taken out of that. Now, based on the 4-hour, when it gave its first entry signal, it's clear up here, you would have received about 150 pips. So almost double the number of pips. Many times it's more than double, other times it's a little bit less, but generally it's more pips for the same effort trading the larger time frames. So that's just a reminder to, you can time your entries on the smaller time frames, but as soon as you can, move up to the larger time frames to manage them. Give the market enough room to move so that you're not cutting your trades out before they have a chance to actually develop. Now let's take a look at using a combination of the larger time frame and the smaller time frame. Now, before you got your really good entry signal, we mentioned it was clear down here, but the market moved a long way before it got to that point. Now, there was a point where you could actually tell as soon as the price had gone up and came back down and was at least equal to where it started. That's a heads up. That doesn't mean jump in and take a trade. That's just a heads up based on the 4-hour. So we put this other line here based on the 4-hour chart. Now let's go look at the 30-minute and see what that would have looked like if we were to take a trade there. Right at this line right here, this is where the 4-hour went up and it came back down, was basically at the same point that it entered, which would be a doji bar or just a little bit less. You can see that the 30-minute then gave you a good entry signal clear up here. So a combination of the 4-hour and the 30-minute, as soon as the larger time frame gives you any indication that it might be going in the opposite direction, look for timing on your smaller time frames and check it out. So in this case, you could have actually, using the combination of both of them, taking just one trade and gone 225 pips. And so that's just a way to look at the market by using larger time frames to the setups, and that's usually the setup's confirmed there, and then using the smaller time frame to time your entry. Hope you're able to learn something from this and give you a new perspective on how to trade time frames. It's one of many ways of looking at it, and we'll talk to you later.